Keppel Infrastructure Trust. Now, what's the business trust? Okay, for us, okay, so there are basically different business structure. Like for example, a company, you have a company, you have a partnership, you have sole proprietor. So business trust is just another structure. Now, what is unique about this structure? Okay, business trusts are allowed to pay dividends to investor out of operating cash flow. This is unlike companies which can only pay dividends out of accounting profit. Okay, the best is for me to use an example. Okay, if let's say what you see here is a company, for example, assuming this is a company, and company make a loss here, can the company actually distribute dividends based on 2012 earnings? Yes or no? Okay, someone help me here. Okay, company can only distribute dividends based on accounting profit. Okay, by Companies Act, company can only pay dividend out of accounting profit. So if let's say company 2012 make a loss, can they distribute dividends based on 2012 earnings? Okay, thank you so much. The answer is no. Answer is no. Okay, if it's loss, company cannot give dividends based on 2012 earnings. Okay, answer is no. Okay, just to clarify, okay, but there can be situation whereby, let's say this is a company, 2012 is a loss, and yet companies still give dividend. Why? Okay, here's the question. Okay, just as I mentioned, yep, they cannot give dividend based on 2012 earnings, but there can be, thank you so much. Companies can actually give dividends from reserve, which is previous year's earnings. Okay, as long as the reserve positive, at least previous year profit, they can give anytime. Doesn't mean that, 2012, I must give dividend only in 2013. No. Okay, I can actually give, today I can actually give a dividend based on profit made in 10 years ago. Okay, yes, retained earnings reserve is the same thing. Okay, but if it's a loss, they cannot give dividend based on the loss. Okay, but business trust can actually give dividends out of operating cash flow. Okay, I hope you all remember accounting profit. Okay, accounting profit. Okay, companies have to do P&L statement. Is for who to see? Okay, I know I asked a lot of times, so someone please help me answer. Company do P&L statement. Okay, for IRAS. Thank you so much for IRAS. So basically, this is what we call the accounting profit for tax purposes. Okay, it's not equal to the cash profit. Cash profit is what is actual money that come to the bank. Okay, so in this case, 2012, the cash profit is actually positive. Anybody know why? Okay, look at this number. In 2012, company, thank you so much. Okay, because of non-cash item like depreciation, can you see? There's a depreciation of 55 million in this case. Okay, this is a non-cash item. They are recognized in the P&L, but in actual fact, there is no 55 million that leave the company. Company did not pay out this 55 million. Okay, so basically, if you add back this 55 million, the company actually has what? Has positive cash flow. They actually have money that come into the bank account. And because if it's a business trust, they can actually distribute dividend because for business trust, they distribute dividend based on operating profit. Unlike companies, they can only distribute dividend based on accounting profit. Okay, if whatever I said 5 minutes ago can understand, don't mind, just help me type a 7. If you don't know what I've been talking about, please help me type a 9. Yeah, thank you so much. Okay, the rest wouldn't type. I assume it's a 7. Okay, so anyway, this is what business trust is about. Okay, why do we have business trust? Very simple. I know Singapore is just a copycat. Whatever US have, we have. That's all I know. Okay, like Singapore, why Singapore have REITs? Because US has REITs, we just copycat. Or we just copy what the world does. So it's not something just for Singapore. This is global. That's how this is this is done globally lah. Okay, so I really don't understand the history why business trust is there. Okay, but it is what it is. Okay, so if you understand the concept of business trust, that means it's actually good for companies who want to give dividend but they have very high depreciation. Okay, that means companies who actually want to give high dividends and yet they have high depreciation. Okay, then they will choose business trust. So usually it is a very good dividend instrument. You buy business trust for dividends. Yeah, that's why, later we talk about Keppel infrastructure. You should also look at it as a dividend instrument. So these are just some also information compare business trust and REITs. For dividend distribution, for REITs, they have to distribute at least 90% of the profit. Business trust don't have to. For REITs, there is a mandatory debt ratio limits. They cannot borrow more than 50%. Business trusts don't have such debt limit. For REITs, they enjoy tax transparency. Business trusts, no, they are subjected to income tax. So some of the things to take note. Basically, REITs, they're more restrictive. Business trusts don't have all these restrictions. Business trust is not subjected to the following restriction which REITs have to comply. So these are rules that REITs have to comply, but business trusts don't have to. So compared to REITs, business trust is more lax. Okay, REITs, you have a lot more rules to follow. Okay, for REITs, they have to at least 75% invested in income producing real estate. They must not undertake property development unless with REITs intend to hold the property upon completion. Investment in uncompleted property should not exceed 10% of its asset. Okay. Okay, let me just check. Okay. REITs cannot have more than 5% invested in other issued securities. So not more than 10% of REITs revenue should be derived from source other than rental payment. So basically, REITs are a lot more restrictive. Business trust is less restrictive. But both of them are actually more to give dividends. As you can see, both of them are actually structured to give dividends. Does that mean that the underlying asset in business trust will keep depreciating? Okay, so this is from an accounting perspective. Kevin's accounting perspective. So basically, all assets will depreciate. Okay, from an accounting perspective, not rich dad, poor dad. So all assets actually will depreciate. Okay, now, so currently now we only have 7 business trusts. Okay, we don't talk about hotel REITs. So for hotel REITs is actually what we call stapled security, which is a business trust plus REIT, but basically they act like a REIT. So if you talk about pure business trust, currently we have only 7. So a lot of people thought CapitaLand India Trust is a REIT. No, it's a business trust. So this is a business trust. So we also have REIT. We also have business trust that hold property. That means they behave exactly like REIT. It's just that they are not subjected to all the rules and regulations. So we have infrastructure business trust. So instead of holding property, they hold infrastructure. So later we'll talk about Keppel infrastructure. So we have 3. We have a shipping. So basically the underlying assets are actually the ships, the ships. And Hutchinson Port Holding Trust. Okay, so their underlying asset are ports. So Valerie, yeah, lah. Basically, you are interested to give dividends and you have high depreciation. Oh. So we are talking about companies like, as you can see here, companies which have very high investment in infrastructure, or you have very high asset, which means high depreciation, and yet you want to give out dividends. So business trust is is a good structure to do so lah. So for REITs, of course, only property, but for business trust, the asset can be anything else, as you can see here. Okay. So good. So let me come back to Keppel Infrastructure Trust. Keppel Infrastructure Trust. So as you can see, this is a snapshot of the asset they own. So is can be energy based, or I don't know what I call it. Okay, sorry. The keyword is utility based. Utility based. So they have things like waste to energy plants. They actually have the water. I always do not pronounce desalination plant. Okay. They have oil rigs, as you can see here. Okay, so it's very utility-based type of assets. But compared to REITs, the underlying assets is expected to increase in okay. No, okay, so Kevin, I don't think I don't agree with that statement. So yeah, I don't think so. Okay. Or either that is it's not anything, it's not definite. It's not definite. Okay, in fact, I think property has a better chance of increase in valuation. So based on my understanding. So just to give you a visual of what are some of the assets. Of course, they are more I mean, if you're interested, you can just go to the website. They will show you, a long list. It's utility-based type of assets. Now, how they make money is actually not by rental, but it's by contract. So just to give you a sense, like for example, in this case, they have this plant, they basically generate electricity for Keppel Electric. Yeah. Okay, the customer is actually Keppel Electric. So instead of like REITs is rental of properties, no. So this one they actually sell utilities, or either that sell a service. Okay, like in this case, they actually sell electricity. And please take note, the contract is usually okay, I would say shorter. Shorter. Okay, like for example, in this case, up to 2030. Okay, it could be extended. We don't know. So this is how they work. Okay. Whereas, like for example, in this case, this one is okay. They actually help to incinerate. That means burn the waste. Is providing the service to NEA, as you can see here. And you can see that the contract is 2024. So in fact, it's going to end this year. Okay, now, question time. So basically, all this asset, in your opinion, do you think okay, how should I ask the question? Okay, do you think there are okay, like for example, okay, I think I don't know how to ask. Never mind, I just give the answer. Okay, time of the day. Okay, anyway, okay, like for example, assuming let's say the contract end 2024, assuming NEA don't want to renew the contract. So basically what's going to happen? That means that's it already. This plant can be worthless already. Correct? I mean, this is talking about NEA. There's only one NEA in Singapore. There's probably only one entity that needs waste to be incinerated. Okay. So if you ask me compared to property, these are less stable because let's say, for example, a property I rent to tenant A. Tenant A want to go, it's okay I can get tenant B. But whereas for them, their customer is most of the time is very few or in fact there's only one. So if let's say for example the customer don't want to renew, I believe the asset can be totally worthless. Okay, that's why Kevin, back to your question, I don't think it will increase in valuation. So assuming like in this case, if let's say NEA, assuming SEA don't want to renew the contract, I don't know who else will actually want to buy this asset. Don't know for what. Maybe can buy, maybe the Zook will buy and turn it into discotheque. But I think this one is at Senoko. I don't know who want to go Senoko to disco. Yes, they are essential, but they are not the only one. Okay, they are not the only one. Like for example, incinerator plant, if I don't want you, I can actually, build somewhere else or, um, find another building to build. Okay, I'm not saying that NEA won't renew. I do agree that, okay, very likely they're going to renew. Okay, but I'm just saying, if let's say, compared to property, if let's say the tenant leave, I can find new tenant. But in this case, for them, if the customer go, okay, I think it's a little bit more challenging. Okay, isn't it built for X number of years as in contract? It was built for the X number. Okay, that one, okay, may not be. Okay, may not be. So different property may be different, especially now they have overseas property. Okay, so may not be. You have to read individual. After X number of years closed down, may not be. May not be. Also, Valerie may not be. Yeah, correct. Like what Lei Hun said, nuclear plant coming and electricity, okay, it may be dysfunctional. Then who will take over? Okay, like I said, like for example, for REITs, right? Let's say your property is in CBD. Even let's say your property is worthless, your property is tear down, the land worth money. But this piece of land is at Senoko. So I don't know whether still have value for the land. Would they not have depreciated? Okay. So THK, I'm not interested in the accounting aspect. End of the day, as an investor, I want to know whether it can generate cash flow or not. You know what I mean? So if let's say, for example, like in this case, what you see, as long as NEA don't renew the contract, I'm dead already. I don't get any cash flow. So I don't care whether you depreciate, don't depreciate. Okay, sorry, investor only care about cash. Don't care about accounting. Okay, yeah. So if you ask me, relatively to REITs, is less stable. Less stable. Okay, I think, yeah, Kelvin helped me to put it very nice way, high customer risk. Okay. Okay, now, looking at the distributor income, again, as you can see, is actually a lot more volatile. Okay, not only that, not only they are depending on customer, okay, the what do you call that? The rates can also change quite more. Like for example, electricity, as you know, like for example, our case, our home electricity sometimes is more expensive, sometimes it's cheaper. So I believe it's same for them. So they could probably charge a higher rate certain time for a certain electricity. They could actually charge a lower rate. So you can see the income is actually more volatile. Unlike REITs, it's actually more stable. Okay, the rental income is actually quite stable. You don't change so frequently. Okay, but this one you can see is actually quite significant. So of course, this year we had a good year. Or in fact, last year had a good year. It actually went up. But for all you know, this year will come down. Also something for you to take note. This is definitely more volatile in terms of their income. Okay. But interestingly, Keppel Infrastructure, the dividend has been very steady. Can you see? Very steady, and is on a very nice upward trend. So they probably have done something correct. So at least history is a guide. And as you can see, it's not affected by COVID. COVID, no COVID, you still need electricity. Okay. So yep. Yeah, I know it's a little bit contradictory, lah. Which or maybe put it another way, probably we may not want to just blindly expecting this. Okay, because by right, if let's say they have high customer risk, by right, if let's say it's volatile, income is volatile, so by right, their dividends should also be volatile. But interestingly, it's actually quite steady increase. Okay. So personally, I don't think I can expect this to keep going on forever, lah. Okay. At least their business may not be supporting. So like for example, this year will be quite interesting to see. Okay, like this one. Okay, for those who are interested, you may actually watch out for this one. 2024 this year, they are going to finish a contract. So what's going to happen? Assuming that if let's say they got decommissioned now, then that's it already, there's going to be a drop. There's going to be a drop in income. Okay. Okay. So same thing. Interest cover okay, very nice. Net gearing less than 40%. I'll just use the REIT since I'm actually comparing the REITs. So I compare same throughout. I just use the REITs indicator. And yep, also same. 2026, 2027. I don't know why they want to amass so much debt. So hopefully that 2 years, you don't have any big crisis. If not, this one also get into the trouble. Okay, so exactly I do like REITs. The something very interesting. So given that is more volatile, okay, I will expect higher dividend yield, which is happening. So if you buy today based on past 12-month dividend and current price, we'll look at 8% yield. Very good. 8% yield is very good. Okay. And if history is a guide, not too bad. Can you see they're quite consistent? Value 7.2 now 8%. Oh, quite interesting. So my take here is this. Is it higher risk than REITs? Yes. Are you compensated? Yes. High risk, high return, low risk, low return. Okay. So to each his own. If you don't mind taking the high risk, you don't mind subjecting yourself to some volatility in the income, because like for example, you don't know when you don't know what's going to happen to this. Okay. You don't know whether the electricity is going to be higher, lower, there is definitely more higher risk in this case. But you think that, okay, this risk is worthwhile for the higher dividend yield, I think it's good. I think it's good to go ahead. But if you want something more stable, you want something easier to see, rental is there one, Raffles, what do you call that? The shopping mall is always there. The tenant will always be there. Okay, you want soon can see, can touch, can feel, then of course go back to REIT, then you get a 5-6%. But if you think that you can take more risks, if you ask me, not too bad. Now it's undervalued. The financial wise actually good. Okay, so hope I given whoever that asked about Keppel infrastructure, hope I given you some guidelines to make a decision.